As of June 19th, 2025, Bitcoin is holding steady around the $105,000 mark, a slight pullback from its all-time high near $112,000 in mid-May. Geopolitical tensions, especially the escalating conflict between Israel and Iran, combined with a weakening US dollar, have pushed global investors towards safe haven assets. But interestingly, Bitcoin hasn't behaved like a traditional hedge, not yet. Instead, it's shown a unique resilience, consolidating rather than surging like gold or the Swiss franc. On-chain data reveals something deeper beneath the surface. Major corporate entities like MicroStrategy and Tesla continue to accumulate BTC aggressively, reinforcing Bitcoin's status as a treasury-grade asset. Meanwhile, the US economy is in a delicate balance, with the Fed holding interest rates steady at 4.25 to 4.50% and inflation remaining persistent. In this environment, Bitcoin's appeal as a hedge against fiat devaluation becomes even stronger. The macro narrative is clear. While price action is calm, the institutional foundation behind Bitcoin is quietly growing stronger. On the smart money front, Bitcoin is trading in a tightly coiled range between $103,000 and $109,000. Recent dips into the lower band around $103 to $104K were followed by sharp rebounds, signaling classic liquidity grabs and institutional accumulation. Zoom into the H4 and daily charts, and you'll spot clear order blocks forming around $105,000, aligning with fair value gaps, a textbook smart money entry zone. Simply put, big players are building their positions quietly, right under the surface. Now, let's look at the intermarket dynamics. Spot Bitcoin ETFs in the US just recorded $388 million in daily inflows, their 8th consecutive day of gains. Despite oil volatility and mixed stock market sentiment, this capital inflow reflects one thing: persistent institutional confidence. Bitcoin also maintains a strong 0.75 correlation with NASDAQ tech stocks, reinforcing its risk-on profile, but with a twist. Capital is rotating into digital assets even as traditional risk assets correct. Quantitative models paint a similar picture. Bollinger bands are tightening. On-chain data shows exchange inflows increasing, signaling short-term caution. But seasonality and post-halving cycle models hint at a 25% upside breakout potential. It's the classic squeeze setup: accumulation, range compression, breakout potential building fast. Sentiment? Surprisingly neutral. The Fear and Greed Index hovers around 50, retail traders remain quiet, no signs of hype. Meanwhile, options data shows institutions buying calls while retail hedges with puts. That divergence? It's a clear sign. Smart money is positioning bullishly. Even AI-powered sentiment models are aligning. Positive press around institutional ETF inflows, mixed geopolitical impacts, and bullish regulatory signals create a cautiously optimistic tone across the board. Technically, Bitcoin is consolidating inside a triangle, with a double top around 110K and support sitting tight between $103,000 and $104,000. Indicators like RSI and MACD suggest momentum is flattening, which usually happens before a directional breakout. So here's the plan. Primary entry 103 to 104K, right where the OB and liquidity sweeps sit. Stop loss just below 100K, protecting against structure invalidation. Profit targets? First at 110 to 112K. Next, we're watching the 125 to 140K zone, if momentum confirms. And confirmation? A daily close above 109K or another wave of ETF inflows. In summary, 7 layers of analysis, from macro and order flow to AI sentiment, all point to the same outcome. Bitcoin is coiling up for a breakout. Will you be ready when it happens?